infrastructure, not just like on one cloud-based provider, but we have multiple redundancies. We are actually constantly running 3 real-time copies of our records at all times, second to second, 24 hours a day, 7 days a week. So we're really keeping 3 completely separate operating environments in sync and running them constantly. So it's a big technical challenge when you're really trying to do this at an enterprise scale.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name's Simon Taylor. I am your host for today, author at FinTech Brain Food and head of market dev over at Tempo. And joining me once again, back from a good holiday break, is the one and only Kai Sheffield. How are you doing, my friend? You feeling refreshed and ready to go?
It's great to be back. It was a great break, but I am excited for 2026. It is going to be okay. So OnePay, which is existing like super app that Walmart is kind of associated with, is doing buy, sell, and hold, but there's no notion of actually paying directly because that doesn't really solve a real problem for them. And so, as much as people are excited about Bitcoin and have talked about the Lightning Network, if you would have told them, "Oh, Walmart's like interacting with Bitcoin and Lightning," there were people who thought that would be from a payment standpoint. But it seems more and more that what the market is telling us is that Bitcoin is an asset that apps are integrating to buy, sell, and hold, and they're not necessarily looking, to enable it to be spent. I would say Cash App and Block is the exception. They're going full steam ahead trying to enable Bitcoin to be spent at the point of sale. I think they're one of the only data points that we've seen of a very legitimate payment company that's like really, really pushing for that. Everyone else is focusing on the buy, sell, and hold. So that was my biggest takeaway.
Yeah, and Cash App as well have announced support for stablecoins, and they're going to launch their own as well. So even they're showing some flexibility. Sandy, your thoughts with headlines like this and kind of bigger institutions adopting Bitcoin and crypto? I know it's something that Franklin Templeton has been really a bit of a pioneer in.
Yeah, I think that, these are really illustrative of how people's financial life is becoming all one. Right? It used to be I would have a banking account, I would have a separate investing account, I might have a separate retirement account, I might do some betting on the side on things that I was interested in. And these were all different lanes in my life. And they are all coming together. This idea of the super app is really unfolding in front of us. But I do think that, this is a healthy way of thinking about the world, right? If we're going to transition to a wallet-based ecosystem and away from all of the different accounts that we operate on today, right? This is a necessary step, right? I am going to aggregate more and more of my financial life in my wallet. The app that allows me to access and optimally use those assets in the wallet is going to become where I want to live my life. It's almost like Amazon with shopping, right? The easier it is to shop for everything on Amazon, the more I'm on Amazon. And so I do think this is the direction of travel for the world. I think that a lot of traditional wealth managers have not yet woken up to the threat that this poses to their traditional business. But I do think that a lot of the banks, at least, are starting to wake up to the threat that stablecoins provide to their business. So I think that this will probably be the year that we see the great wealth management awakening to the threats that this provides.
Interesting that the distribution side, as you say, the app side is rebundling all of these different products. You can talk about Robinhood, you could talk about Coinbase, you could talk about many others that have started to go that route, and now OnePay. In your own business, what are you having to do to prepare for that future in the wealth management sector? Like, how do you get ready for wallets and tokens and all that sort of stuff?
Well, this was something we saw coming many years ago, right? I mean, we actually designed our own KYC, AML, which is Know Your Customer, anti-money laundering. We designed our own KYC, AML compliant wallet working with the SEC. We've gotten a patent on that wallet. And we built an entire tokenization platform that can issue tokens, trade tokens, registered fund tokens. And we actually launched our first tokenized fund on that platform all the way back in April of 2021. So we've been operating in this world for quite a while. We now have funds that trade all over the world that we administer via this wallet-based ecosystem. And we're going to be launching many more products into this wallet-based domain over the coming year to 18 months as the market is finally catching up with the benefits that these wallets provide. So Franklin Templeton has been ahead in this regard. What we're finding now is we're needing to do a lot of education. We're having to do a lot of explaining. We're needing to really help people understand why these technologies offer a much better opportunity, right? In financial services, we've had wrappers for decades, right? Mutual fund wrappers, ETF wrappers, separately managed account wrappers, right? And those wrappers have all each offered some incremental improvement to how you can trade financial instruments. But tokenization is a step change beyond that, right? Because they are programmable, for the first time, we really have smart wrappers. And putting a smart wrapper into a digital wallet on a blockchain enables things that have never been possible in the past. And I think that's what we're starting to see many traditional financial participants realize. And they're realizing that, oh my, I need to actually rethink my whole business as a result of this.
See, it seems like you all are leading the way on tokenized securities, tokenized money market funds, and like the wallet infrastructure that you need for those types of products. Do you think about it as that same infrastructure will be general purpose to support any asset, including crypto assets, including stablecoins, and that it'll all live together in the same place? And you know, maybe I'm behind on the headlines, but like today you offer tokenized money market funds. Like, should we expect that it's any asset on chain could then live right next to them in the same wallet? Is that the general direction that you're going?
100%, Kai. That's exactly the vision we have for the future. First off, we are an asset manager. Franklin Templeton has been around for 80 years, and we manage almost 1.7 trillion in assets under management. I would see all the different types of products we provide across that $1.7 trillion platform eventually moving into these channels and being available in a wallet, just like we have it available in a fund today. But in addition, that's just stage one, right? There are so many assets today that are investable, but they are very difficult to trade, right? You think about intellectual property rights, you think about art, you think about farmland, you think about sports teams, you think about movies, right? There's any number of assets that people would love to be able to invest in, but it's hard to invest as a small investor. It's hard to get small shares of those investments and be able to create liquidity around them. And I think all those types of investments too are going to be moving into tokenized wrappers. They will become part of investment portfolios, and those investments will sit side by side with your stable coins, with your Bitcoin, with your other tokens in your wallet. And that becomes my modern portfolio, right? My portfolio today is typically just equities and bonds. I think my modern portfolio has dozens of different kinds of assets in it.
Historically, the 60-40 portfolio was the good advice you start your career on, and that's what you're supposed to do. But for this generation, that's not necessarily returning something when asset prices are so high. And so no surprise that some of them have turned to meme coins and whatever alternative they have available, a trend some people call financial nihilism. What I find fascinating about what you're saying is there's also other alternative assets that do have better yield profiles. Those alternative asset classes like IP, like art, like wine, like many others, that professional investors have been using for some time to give a higher return profile and as part of a balanced portfolio. Why don't we wrap those. But well, the reason we didn't wrap them is they were very expensive. It's very costly. Taking a fund meant that the hurdle rate, you have to invest, $1 million to $5 million to walk through the door. And most consumers don't have that. But tokens easily fractionize, and they're wallet first, and they enable you to do all of that. So it's fascinating that you've already got started. You're already live. You're already in production, and you're already thinking kind of that way down. This next story, I would love your thoughts on as well. I don't know if you saw it, that Fireblocks have acquired a company called Trez Finance for $130 million. Now, these guys are an enterprise platform for financial data reporting around digital assets, and they build a lot of compliance capabilities for digital asset corporations by turning blockchain activity into structured audit-ready data. And I imagine this is a challenge you might have had to solve yourselves internally. But this is, kind of a further consolidation in the space. It's the second acquisition after acquiring Dynamic late last year. And we had both Fireblocks and Dynamic on the show back then. Talk to me about sort of some of the work you've had to do internally to be, a regulated financial institution and deal with all of your obligations and still be in the on-chain world.
Yeah, this has been, an ever expanding learning experience is what we find, that you solve one set of problems and you open up an entirely new set of realizations and challenges. But let me rewind to some of our earlier days in building out our infrastructure, because this data issue is a very important one, right? We realized very early on that if we were going to be utilizing the blockchain rails as a ledger, particularly for holding records of regulated fund shares, that we needed to be able to really access all the data of all the blockchains that we utilized at every moment in time to ensure that we actually had an accurate record of what those shareholders' positions looked like. And so we began actually running our own node operations. And we really do believe that running your own node on these networks is an important operational due diligence procedure that allows you to really be a part of the network and really be engaging with the network moment to moment. And being able to get at that data and have real-time copies of that data second to second is critical for how we have to run the business. So I do think that being able to ingest that data, we had to do a lot of that structuring of the data, that importing and cleansing of the data, that integration of the data into our other systems ourselves. And it sounds like what Fireblocks is doing is trying to create a quicker route to market for others that are going to be buying into those services. And then the other thing we realized is that once you're collecting all of that data and you're relying on that data, you then need to start making sure that you have lots of redundancy in that data. And so, we run our entire infrastructure, not just like on one cloud-based provider, but we have multiple redundancies. We are actually constantly running 3 real-time copies of our records at all times, second to second, 24 hours a day, 7 days a week. So we're really keeping 3 completely separate operating environments in sync and running them constantly. So it's a big technical challenge when you're really trying to do this at an enterprise scale.
That alone, we need to clip that. And that is a playbook for financial institutions that a lot of people don't realize at this stage. If you're serious about building on-chain products, what Sandy just talked through is exactly the mindset that you need to have. And I think it's part of the shift of we've seen, blockchain, stablecoin, tokenization initiatives be kind of in the corner of an innovation center. And when it's there, it's easy to outsource and say, okay, we're going to onboard one provider and just do this through the cloud. And we'll just trust them. There's going to be no backup, no redundancy. I think where we're heading in 2026 is the real value. It's going to be who are the financial institutions who can actually get closer to the metal and say, how do we build and design a stack that is not just going to get us to an innovation POC, but is going to get us to trillions of dollars of assets on chain. And if you're issuing and monitoring trillions of dollars of assets on chain, the idea of outsourcing a critical component of the data operations of what's happening with those things to like one company a fraction the size of you is like very, very hard to do. So I have a ton of respect for that mindset. And we think about that a lot as how do you get closer to the metal and build a foundation that, can scale over the long term. And I think that that's, the expectation that, large customers of large financial institutions have. But back to the story on Fireblocks, I think it's a really smart move. And it also speaks to the shift of, again, you've had products like Fireblocks that at times have been sold to product and innovation teams, where you're either talking to a developer or you're talking to product manager. It seems like this is a shift towards saying, maybe the customer is actually the CFO, maybe it's the controller, maybe it's the auditor. And so, again, as you get to these like bigger deployments, if you can be able to have a stack that's not just here's how we're going to manage your keys, but here's how it connects to your ERP, here's how you have an auditing trail, here's how you have all of those other components. I think that's going to be really important for large enterprises, and the CFOs are going to have a real impact on the buying decisions. And so being able to integrate that into things like key management, really smart move by Fireblocks.
I completely agree. It feels like one, logical product extension into net new revenue, but two, I almost saw it as a signal of like, oh, this is one of those little things that you would only expect to see if they are getting scale and velocity and volume coming through their platform. People will be asking for that if they're pushing into production. They don't ask for that if they're not pushing into production, right? If it is just staying in the innovation theater division. And I think stablecoins have been a big driver of that. But as Sandy was sharing, I think it's going to go beyond that really, really quite quickly. And I just wanted to echo your point, Kai, before we move on, which is I've had 4 conversations with 4 different banks in the last 2 days, and so many of them start at like, we just need to figure out how to be an off-ramp, and can you teach us how to do that? And then they get into, oh, right, that sounds like a lot of third parties. I'd need to be able to move quickly. Can I go directly down to the metal? And then you coach them through how to do that. And then there's sort of like a different roadmap for everybody of how they get to that. But it's kind of the thing I think a lot of the institutions are going to want to do is they're going to want to figure out how they do what Sandy's already done. So Sandy, you could probably build a little cottage industry and kind of going around the banks and financial institutions and talking to all of the hard-won lessons she had there for sure. Just before we move to our next story, I'm going to take a quick pause here while we hear from our sponsors. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's clearing many stable coins across many blockchain networks with many off-ramps. So classic clearing bank. And no surprise, Tony ran clearing at Citi as his last job. So he knows a little bit about clearing. So any chain, any token, one single settlement layer. So I found this one fascinating, Kai. We've had Tony on the show before. The stablecoin conversation past 12 months has been very US focused, but quietly the European banks have also been doing a lot. We're not seeing a lot out of the UK banks necessarily, but a couple of big stories this week coming out of the UK. What are your thoughts on sort of these investments? Do they signal more? And what are you hearing in your network from banks looking to solve this many-to-many problem?
Yeah, so my understanding is that Barclays has tended to be one of the more conservative banks in the space. You don't see them kind of rushing into a lot of different crypto and blockchain type of initiatives. And so I think it's a good signal to say that even the largest, most conservative banks are recognizing the value of stablecoins and are taking meaningful steps. And the investment in Ubix, I think, is the start to that. I think it's a lot of like shout out to Tony and like the network and credibility that Tony has built over the years. And if you can kind of trace the past of like, he wrote the paper at Citi on regulated liability network that then led to working groups in RLN that then led to the BIS, and so he's been able to build this like really impressive ecosystem of leaders inside banks that are really looking at ambitious upgrades to the payments and financial system, and so have been excited to see him with Ubix now, and being able to have some of the banks that he worked closely with on RLN and these working groups kind of following and engaging and investing. I think that makes a lot of sense. And everyone should go back and listen to the episode that we did with Tony. I think his analogy around stablecoins as traveler's checks is like one of the most interesting ways to think about the space. And it's something that, if you're a bank, what I've been saying lately is it's really hard to predict every use case that a customer might want to do with a stablecoin or tokenized asset. It's just really hard to know. But it's likely that some of your customers will end up with some of these assets somehow. Like they'll just like come across them, as they're more out in the wild. And so I think a starting point is if you assume that some of your customers have some of these stablecoins, shouldn't you want them to bring those stablecoins to you and just deposit those into the bank to grow your deposits? And then you need the mechanism to do the clearing and settlement, to receive the stablecoin, redeem it, for fiat, and then have fiat show up at the bank. And so I think it's just like a very natural starting point. Like you don't have to predict the future. You just have to say some percentage of my customers are going to have these. If they have them, let them bring them to me. And I think Ubix has like a really strong positioning on how. Shout out to Tony.
Yeah, I want to echo that because, again, to the point I was just making, how many banks are now trying to figure out how they become an off-ramp? And Tony's like, yeah, and then when you become an off-ramp, which stablecoin are you accepting on which network and or which third parties are you working with? Actually, I'll just hide all of that for you and I'll clear it for you. And then, you can take it from there. Sandy, I'm interested from your perspective in sort of the support you're seeing from the banking sector more broadly. I know, and stablecoin settlement, and where you see the opportunity for that versus other assets in your business and what you've been doing in that space.
Yeah. So first of all, I just want to echo your guys' shout outs to Tony. He was actually the person who taught me about stablecoins. He and I worked together at Citi, where I was doing a lot of thought leadership around tokenization as he was doing his work around the regulated liability network. So to me, Tony is one of the absolute greatest thinkers in the space. And I have watched with great enthusiasm as he's built out Ubix. I do think that, the whole conversation with banks and stablecoins is pretty fraught, right? If stablecoins are really doing what stablecoins are meant to be doing, then the banks are going to be losing those deposits, right? And you see a lot of banks already taking very defensive postures in trying to offer tokenized deposits as opposed to really getting behind and offering stablecoins. Because a stablecoin, once it sits in my wallet, can recirculate wherever I would like to recirculate it, right? Whereas a tokenized deposit has to come back to the bank, right? And I think that banks are hoping that by offering these tokenized deposits, they can create an instrument that siphons off some of these cross-border flows from stablecoins and kind of reduces the outflows of deposits that they're seeing. But to the point Kai made, inevitably you're getting stablecoins both into and you're getting funds out of the bank into stablecoins. So being able to be interoperable across the entire set of stablecoins that are emerging is critical. And I think that stablecoins are going to come from more sources where people aren't going to have a choice, right? A headline that was recently out for us is that we have helped the state of Wyoming launch their own first stablecoin. And we are doing the reserve management for the state of Wyoming. And what's interesting about that is that the state of Wyoming is going to be making statewide payments in their own stablecoin. Right. So if I am a resident in the state of Wyoming and I'm getting paid food benefits, I'm getting paid a tax refund, I'm getting paid any kind of federal statewide service, I'm going to receive these Wyoming stablecoins. And I think that this is going to set a model that a lot of other organizations are going to want to follow. So I do think that we are just at the beginnings of this proliferation of stablecoins and different stablecoin types for different use cases. And the banks are going to inevitably have to be able to interoperate across this whole space, or they risk really losing those deposits permanently because once it's sitting in my wallet, and I have any kind of self-custody arrangement, I can start moving those stablecoins around at will. So I do think that, a lot of banks are still trying to wrap their heads around what their strategy should be here. I think they have both a nearer term strategy to kind of prolong any defensiveness that they need to think about. And then they probably also have longer term strategies where they need to rethink where some of their own differentiation comes from. So I think it's a tough situation for banks, but I do think being able to interoperate is going to be critical for all players, banks included.
Yeah, and that interoperability is really key because there's a number of initiatives. There's Swift, there's Project Agora, there's the Clearinghouse, there's Kivalis in Europe. There's countless consortia popping up, and then there's also the internal tokenized deposits. There's Kinexys and there's City Token Services and it's not clear to me that all of these deposits use the same token standard. It's not clear to me that these things could technically interoperate. That if I sent that to a market maker, it would exchange evenly, and on what network would it happen? None of this is really figured out yet. And so having somebody going, I know it's a mess, I'll just clear it, whatever it is like a real it's not a vitamin, that's a painkiller. Like that solves a problem that I think we're inevitably heading towards. And Kai, I sort of asked you the question about client demand because I suspect that's the case that you're hearing as well. A lot of it's coming from some crypto natives, but also just corporations that operate in long tail markets for cross-border have stablecoins, and they just want to get in and out of their regular bank account. Like they don't want it to be in a different place. Do you think that banks, as people that ultimately do listen to their biggest clients, are going to acquiesce, and we're going to start to see them off-ramping stablecoins in some of the GSIBs? Do you know of any already doing that at a big scale for their corporates?
I'm not aware of anyone that is doing that today at any scale of any like large bank. I think before the holidays, we announced our partnerships with Cross River and Lead Bank and how we're working with them on stablecoin settlement. And so arguably that's one of the first examples of banks that are actually sending and receiving, holding, touching like stablecoins, not just tokenized deposits. So I think that's a pretty big deal, and it makes sense that those are the early movers, and they serve the most sophisticated fintechs and crypto native companies, and so their clients were clearly asking them to say, hey, like we want to be able to send you stablecoins, and so they're building the capabilities. And Cross River, Luca talks about how they were able to integrate that with their core ledger that they built in house, and so you can send a stablecoin and get fiat back, and I think that makes a ton of sense. I think the big question will be from the larger banks, who ends up being the early movers there. A lot of them are very focused on tokenized deposits and making significant moves on kind of their own products. We have not really seen many lean in publicly today and say, we want to accept all your stablecoins. And I think that there's an opportunity that the first major banks that say we're open for business, send us a stablecoin, and we'll accept it, and your account will immediately show up as a deposit. I think that's an attractive service for a growing demographic of consumers and businesses that are coming across these. But there's a bunch of questions around. I think the infrastructure to do that doesn't exist at scale yet, and so I love what Tony's building with Ubix, but it's still early stage, and so. Like, how do you actually manage acceptance of a stablecoin across multiple blockchains and the ability to clear it and send it back to the issuer and redeem it for fiat? And are you going to immediately credit the customer's account even before you've been able to redeem the stablecoin? What happens if you can't redeem the stablecoin? Like, there are all these things that you have to think through. But I think in 2026, like for sure, like the fintech banks are really ramping up. And then I think you'll see large banks start to dip their toes in. But there is this interesting strategic decision around, you could either say, we're going to go all in tokenized deposits and try and convince the world tokenized deposits are better than stablecoins and you don't need them. Or you could say, like, we're not even going to try tokenized deposit. We're just going to say stablecoins are going to happen. We're going to try and meet stablecoins where they are. Or we're going to meet somewhere in the middle and have our own tokenized deposit and accept stablecoins and figure out how they interoperate with each other. I tend to think that middle lane is probably a better risk-adjusted bet than going to the extreme, one or the other. But I think that'll be interesting to see.
You can almost see, I think, the Overton window shifting in financial institutions in Jamie Dimon's speeches on the topic. So if you wind the clock back 12, 18 months ago, and certainly 6 months ago, it was, we believe, deposit tokens, JPMD is superior because it offers yield. Like, why wouldn't you want this? We think it'll outcompete stablecoins, especially when the Genius Act first passed. That has mellowed somewhat since then, and I think the reality of stablecoin adoption and also bankers, for better or worse, they do this to their clients, especially their biggest clients. When there's demand, they will service it and they will do what their clients need them to do. That's the nature of especially the big banks. So I think it's going to be fascinating to watch. I want to move us to the next story because it's bank related as well, and this is from Lloyds Bank, the other large UK high street bank. They completed the first UK gilt purchase, so our equivalent of treasuries, using tokenized deposits. This was done with the help of Archax, a UK company, and of course CANTON, friends of the show. Lloyds issued its tokenized deposits onto the CANTON network, and their corporate markets division used those tokenized deposits to buy a gilt from Archax, who was the broker of those gilts. And then Archax moved the underlying fund back to its regular Lloyds account. Sandy, what do you think of this use case in particular? Because I know that's sort of almost reaching into the other side of Franklin Templeton, like it's classic business. Any thoughts as you saw this story pop up?
Yeah, this is just the very tip of the iceberg. I really believe that you're going to see more and more and more transactions being done completely on chain for underlying assets, not just funds. And I think that the forms of payment that people are going to be using is going to be expanding pretty dramatically. We actually, in our thought leadership, kind of refer to it as we're moving into a high-tech barter society. Because not only can I use a tokenized deposit, I can use a stable coin, but why wouldn't I be able to use tokenized gold? Why wouldn't I be able to use a cryptocurrency, right? If I'm looking to buy an asset, I should be able to buy it with any form of payment that is transparently valued and exchangeable, and be able to do that instantly on chain. And so I think this is really, a strong signal that we are going to see the entire financial market infrastructure shift onto new rails a lot faster than people anticipate, right? The benefits that are gained through this are going to be seen instantly, right? We already at Franklin Templeton can allow clients to subscribe and redeem from our money market funds using stablecoins. We're going to be able to allow them to do that using tokenized deposits. We're going to be able to allow them over time to do that using potentially other forms of payment. And I think that this ability to go seamlessly between these different instruments is going to be, I think, foundational to how the new ecosystem works. And to go back to the conversation we were just having, the banks are going to struggle here because their systems have not been built to operate in real time 24/7 like this. They need to reconcile back using batch processes. And so if I accept a stablecoin as payment, I can give you that stablecoin instantly if you are on chain, but then to get the funds that stablecoin represents back into your bank account, even if the transaction happens on chain right away, the actual funds may not hit your bank account for some time. And I think that this is going to start to be seen increasingly as an unacceptable drag on your own potential money and the way that what you can earn on it. And that is going to push people to transform a lot faster, I think, than many anticipate at this time.
Sandy, I have a question for you that I've been thinking about over break. I'm hoping you can help me answer. I'm going to take like a long-winded way to get there, so bear with me. But I think what you're saying, it really resonates, is the amount of working capital that an end customer needs to have over time should decrease down to near zero. Like if you think about like what does an average customer have in their checking account, like how much money do they need to have? It's partially a function of how slow it is to be able to take any other type of asset that's not cash and get it into cash. Because my preference would be to keep 100% of my assets and kind of liquid net worth in assets that earn some return, not in cash or deposits in a checking account that are earning barely nothing. But I have to keep some deposits there because of the fact that I have bills that come in and I can't immediately convert an equity that I have to pay a bill that's outgoing. So it makes sense to me that that working capital comes down over time as every asset becomes more liquid. Now, what you said around, okay, you could have all these different types of assets that are tokenized, and then you could actually spend, maybe you're spending a fractional share, you're spending a tokenized money market. That seems kind of like a tax nightmare of like actually spending the assets themselves. But the thing that makes a ton of sense to me is why can't I just get a credit line against my entire portfolio that's cross collateralized against all my assets? So if all my assets are on chain and I have money market funds, equities, crypto, like whatever it is, shouldn't at any point of time I could just open a credit line and be able to borrow, against those assets and then be able to spend? And that would be a really, really powerful product. What are the barriers to that happening? And frankly, why doesn't that exist today? Like, why can't I go in my Robinhood account and say I would like to get a credit line of 10% of my assets in Robinhood that I could immediately spend against? Does tokenization solve that? I don't even understand why it's not happening today with traditional equities outside of these like prime broker, high net worth, like one time type of loans.
Yeah, I mean, in a sense, it's like if we can offer buy now, pay later at a point of transaction checkout, why can't I be looking at my entire wallet-based set of holdings as a collateral base that I could be borrowing against? And it wouldn't even have to be a credit line. It could even be a flash loan for the bill you have to pay in that moment, right? Because you have all of that collateral sitting in your account, and the only hesitation is going to be how long does it take the cash to actually get credited to me? And so I do think that these will become services. I think that if we get the Clarity Act or if we get some more market structure enacted and more global regulations, I know they're very actively working right now in the UK and they have the MiCA rules that are coming in. I think this will become easier, and these are going to be new services that get offered regularly, right? And I think this is where there is such an interesting, super interesting convergence of agentive AI and blockchain coming together. Because really what I need is I need a logic layer that sits over my smart contracts that can actually start to algorithmically assess, right? Assess all the assets I have in my wallet, figure out my optimal form of payment or figure out my optimal collateral and automatically make a determination and create the contract to move that. And I think that's what will enable, Guy, that vision that you laid out there, which is, every asset should be almost instantly transferable into either collateral or cash. And then if that's the case, I need smart algorithms that are going to work at that speed that are really optimizing my options on how am I going to actually manage my overall pool of wealth. And this is why I think, to go back to what we were talking about earlier, this idea that I have different pools or different lanes that I manage my financial life in become untenable, right? Everything has to be together so that I am constantly optimizing all of my decision making and all of my options to make sure that I'm earning the most potential I can with every asset that I have in my portfolio. And I really, really believe that that is the way that the future financial ecosystem is going to operate.
Yeah, like the vision is achievable if everything's inside of a wallet. If everything's on chain and inside of a wallet, we just need to kind of get there. And there's a lot of systems and sunk cost and legacy providers where most of the capital is that are not there yet. But I like this idea, Kai, that when you mentioned earlier that Luca at Cross River was able to do the stablecoin integration directly to their core, but they self-built their core and it's a 24/7 core. They're not reliant on that batch processing in order to catch up. So I think it's kind of fascinating that Lloyds Bank here is doing something meaningful, that they're doing something useful that clients could get some value from. But it is one transaction. I'll be interested to see if this becomes many more transactions thereafter. And would this buffer at scale, if there is then giant gap between sort of what the on-chain record says and what the system of record inside the bank says. And I would love it, Sandy, if this became the thing that forced everybody to upgrade those internal systems over time, because that probably would unlock a massive amount of GDP. People don't realize how much working capital is tied up in dealing with just the delays in the banking system. Like, what a gift to the world unlocking working capital would be. How many jobs would we create? How much human flourishing would come off the back of that? But I want to draw your attention, Kai, briefly to the Canton piece as well, because there's been a lot of discourse on X and elsewhere from some of the more crypto natives and true believers that, you know, Canton's not a real blockchain. It's not really decentralized. You know, most of what they're doing is with Broadridge on the RWA side. And I get the sense that there's a bit of a misunderstanding of how Canton's supposed to work, in that it's like the Swiss cantons. Like, yes, there are almost like the Avalanche model of, like, there's the core L1 and then there's these sub L1s that you can build on the subchains that they have. And so you could have something really, really big, but those are designed to kind of talk to each other. Your thoughts on the Canton portion of this?
Yeah. So first, like, shout out to Yuval and Eric, and, you know, these guys have been building for a decade. Like, so it's not like this is like an overnight thing that, you know, they launched something and, like, now you see all these announcements. It's like they've had a long-term vision that they've been building towards, you know, with, you know, a different approach than most of the industry has taken. And I think that they're now, you know, starting to get, you know, more and more traction and momentum. I think arguably Canton was one of the biggest stories over the past month in terms of, like, where is there real activity and interest in, you know, more announcements, more partnerships, and integrations coming. You know, Canton Coin I think is up like 80%, you know, in the past month. It was one of the best performing crypto assets in the past month, which, you know, people wouldn't normally expect. I think that's part of, like, what causes people to say, like, wait a minute, like, what's going on here? It's now like a $5 or $6 billion valuation, and so I don't understand all of the details, you know, enough around the, like, architecture and the mechanics of the network. I will say that it is pretty different than existing blockchains, and, like, by design. I think they've taken an approach that privacy is just a critical default feature that has to exist. And I think that was a good bet. And it seems today that, you know, institutions are validating that, you know, they're able to credibly go and say, we are a network that is operating on-chain, you know, use cases in a fully private way that's, like, live at scale. And, like, I don't know that many other networks that can say that. And so, you know, I'm excited to see kind of how Tempo privacy solution plays out. I'm excited to see what Arc does. You know, I'm excited to see what Solana does. So everyone else is, like, waking up to privacy is important and we have to build it, but nobody else is really able to say we have a live product and network that has privacy preserving capabilities that you can use today. And so I think that that's a pretty valuable thing for them to be able to go to market with. And my understanding of the way that works is it is kind of this subnet type of structure where you have individual applications that an institution can build that has, you know, full privacy. And so it's kind of their own, like, you know, internal ledger. They can do any transactions that they want there that are, like, on us, you know, intra-bank, you know, transactions. But then there's this concept of the global synchronizer where you could have interoperability between these different apps. Now, what's not clear to me is how much of that interoperability exists at scale right now. It seems like most of the early use cases are individual apps. I think the Broadridge one, I could be wrong, but, like, I think that's like an individual app. But there is a growing ecosystem of some really, you know, impressive infrastructure providers that are enabling, you know, some of the nodes and capabilities for it. And there's just a growing list of institutions that are finding interesting use cases that they want to build on. So I think it has a lot of momentum right now and is pretty differentiated in the overall, you know, blockchain market for many capital market use cases. But Sandy, what do you think? Like, you've been following chains for a while. What's your, you know, Canton take?
Yeah, it's super interesting. I mean, we have deployed the infrastructure that we've built across 10 different public blockchains. And Canton is the only private blockchain that we have also deployed across. So we do run on the Canton network. We do run on the main Canton network, but we have done it for exactly the reason that you called out, Kai, which is we have clients who, because of their trading strategies, they want to be able to have privacy. They don't even want a wallet address available so that people can see kind of what's moving in and out of the wallet. They want that complete privacy because they feel like not having that, even if it's only pseudo-anonymous, really erodes their trading edge. And so I do think there's going to be very specific use cases that are going to always require privacy. And I think you're going to need to be able to offer a range of solutions. I mean, one of the reasons we've chosen to operate across so many different blockchains is we do find that there are a lot of different use cases, right? That we have a pretty complex set of order algorithms that really determine which blockchain we use for what types of orders. Because we find that the economics of each chain are different, the characteristics of each chain are different. And so, people who always go back and say, oh, well, we're going to be in a one-chain world or we're going to be in a one-chain compatible world. I do think you're going to have to be able to interoperate across chains, but I still think that those chains serve unique functions in many cases. And I think Canton is interesting, and it is getting traction with a lot of traditional players who want that privacy, but who still want a chain that is actually up and operating and it's not being kind of spun up. To go back to what we were saying earlier about this whole idea of, I don't want it in the innovation lab. I want to be able to run a business on it. And so, yeah, we are deployed on Canton, and that is one of the networks that we're doing node operations on, and that is one of the networks that we operate across regularly.
It's fascinating seeing how much sort of the reality of the world you live in with Canton and the client demand you have is something you have to respond to. And I think a lot of people that are coin holders on X, they can make a lot of noise sometimes, but don't understand some of the motivations and the drivers of some of these bigger institutions. And maybe that's not what they're trying to build, and all power to them if they're trying to build something else. There is one last story I just wanted to get a quick take on, Sandy, before we close out today, which is, I don't know if you saw that Morgan Stanley filed for an Ether trust after sort of a Bitcoin and Solana ETF push. They're also going to plan to launch their own digital wallet in 2026, which probably speaks a little bit to your everything will be a wallet thesis. But your thoughts on some of the financial institutions moving in this direction?
Yeah, I think that this move, and we're seeing it not just from Morgan Stanley, but I would say all of these major wealth networks. They have realized that clients have moved money away from their wealth management products to places where clients may not want to be operating long term, right? Like a lot of people have money that are holding on Coinbase right now that, given their option, they would prefer to move it back into Morgan Stanley and have it aggregated with all of the other assets that Morgan Stanley manages for them so that they can see their entire pool of assets. And in order to be able to bring those assets back onto their platform, Morgan Stanley has to provide both the infrastructure to hold the assets, which is the wallets, and then they need to allow these clients to determine if they want to redeploy that money out of a wallet and out of a crypto-based holding into an ETF. And so they're going to have some clients that want to go the traditional client account route, and they're going to have some clients that may prefer to start moving more of their other investments into the wallet. And I think that this is them putting into place the first stages of an infrastructure that's going to enable that two-way. And that is really how we think of our whole business, that, we're going to have to offer exposure to all of the crypto and the crypto ecosystem and the great development and growth going on there. And we're going to have to offer that in traditional wrappers that work in account-based systems and batch processed systems. And we're going to have to offer our traditional products that people are looking for diversification and for additional yield. And we're going to have to offer those in a wallet in a tokenized structure. So I think every financial firm is going to have to be able to interoperate across those two extremes for the next decade at least.
Wow. It's going to be an interesting challenge, a lot of work to do. The revolution will be tokenized, one financial institution at a time. Look, that's all we had time for this week. I want to thank our viewers for watching, listeners for listening as well. Sandy, if people want to learn more about what you're doing at Franklin Templeton, where do they go to do that?
Good year for alts. Alts have good years, they have bad years. 2025, I suspect this is going to be a good year for alts. Alts have good years, they have bad years. 2025, this was one of the bad years.
At the start of this cycle, many investors expected altcoins to perform. 2025 didn't play out that way, and even experienced investors had to rethink their assumptions.
So that's one thing that the market got wrong, and I think I got that wrong as well, is that was not the outcome that I was expecting.
If we look back at 2026 in hindsight, what is it that most crypto investors will realize that they were wrong about?
What will they realize that they were wrong about? I predict that if you look at the alts market,
about 87% of the people that are watching aren't subscribed. If you choose to subscribe, we are able to be getting better guests and to do more in-person conversations. It doesn't cost you anything. It helps us.
About. One of the things is that I think people today are trying to diagnose a bunch of potential ills in the altcoin market. I think people think that, well, the fact that altcoins went down in 2025 must mean that there's some deep systemic problem with alts. Maybe there's too much conflicts between the devcos and the tokens, or maybe there's too much oversupply. Maybe the market structure is broken. Maybe the market, maybe something fundamental changed after 1010. And I think people will look back and they'll forget they even had these conversations. I feel like every cycle we get all sorts of, witch doctors coming out explaining to you, oh, it's because, the moon was in this shape and this thing happened. That's why all the markets did what they did this year. And the next year, people totally forget about it. And look, when prices are going down, everybody demands an explanation. When prices go up, nobody asks anything. They're like, oh yeah, of course they go up. They're supposed to go up. That's how crypto works. And so I suspect this is going to be a good year for alts, and that it's going to erode a lot of the soul seeking that we're seeing from the market right now.
I've seen, to your point, I've seen critics being on social media on literally every platform out there. Every platform that tried to build something sustainable has received negative feedback. Right. So in light of this question, what did people get wrong about last year?
What did people get wrong? I think there was a little bit. There was a few things that people got wrong. So one, obviously, people, going into last year, Trump had just been elected, not yet inaugurated, and people assumed that this was obviously going to be a good year for everything in crypto. And what we saw was that Bitcoin was flat to down on the year, pretty close to flat. Everything else was down. A few things did well. So, XRP and ETH and so on, they staged reasonable returns. But it was a much more mixed year than people were expecting, which I think the lesson there is that regulation, so much had already been priced in by the time that Trump got elected. And the expectations seem to be somewhat out of line with reality. Is that Trump, as much as Trump is the most powerful person in the world today, he is surprisingly ineffective at actually being able to champion the broader universe of assets within crypto. The amount of incremental demand that we got from Trump, as opposed to the anticipation about Trump, was a lot less than people were expecting. So that's one thing that the market got wrong. And I think I got that wrong as well, is that was not the outcome that I was expecting, especially after seeing what happened with Trump's meme coin in January. The second thing I think that we got wrong is that there was a zeitgeist in crypto at that time of financial nihilism. This view is that, well, the only thing that matters is that nothing matters. Nobody believes any of this stuff. They believe it's all bullshit. No one really cares about the technology. This is all just, us playing a shell game on a sinking Titanic. And as a result, what you should expect is that most of the demand and most of the product market fit for crypto is going to be in the casinos. It's going to be in meme coins. It's going to be in AI agent coins. It's going to be in all of the stuff that we were talking about at the beginning of 2025. And really what you've seen over the course of 2025 is that the center of gravity of crypto has moved away from speculation, away from pump.fun, away from all the meme coin casino, more towards stable coins, RWAs, traditional businesses coming on chain. That's where the center of gravity crypto has moved. And so I think that was, again, a big miscalculation by the median crypto investor, is thinking that this was what crypto was about. Now, I think I was in the minority on that point. And being a VC, maybe it's easy for me to be in the minority there. But I think that was one of the things that the market generally got wrong.
If we look at the markets right now, there's some, I think there's some sort of momentum being built up at the start of the year. And then there's always the question, which narrative is going to be it for the coming period, or which narrative is going to lead the next run?
Yeah.
Which narrative do you believe is currently classified as obviously the one that's going to do it, but in hindsight won't be it?
Is obviously the one that's going to do it, but in hindsight,
Because right now, for instance, prediction markets are literally all over the place.
yeah,
Stable coins is a big narrative.
that's right.
Which one is going to fail?
I think tokenization is probably the narrative that will be most highly anticipated, but will underperform the most. The other one I would say is, I think these fintech chains, so Tempo, Robinhood Chain, Arc. I think the idea that, okay, well, now these big boy companies are coming on chain and they're going to launch their own distribution channels or their own platforms, and that's going to usurp a lot of the demand or a lot of the block space from the big traditional neutral incumbents like Ethereum and Solana and so forth. I think that narrative is also going to underperform. So now, why do I say that for these two narratives? For RWAs, or for tokenization, I actually think RWAs are going to do well, but RWAs more inclusively thinking of things like equity perps, right? Which of course are not, they're not spot, they're cash settled instruments, right? They're derivatives. I think actually the derivatives are going to do very well, and the tokenized assets are going to do relatively poorly. Right now, the biggest tokenized assets that we have are tokenized treasuries. But as you see yields start to come down, as you see the Fed start to cut more aggressively, you're basically going to see less growth, I perceive, in tokenized treasuries. And if there's more demand in crypto, then things like the basis trade yield or things like private credit are going to become relatively more attractive than tokenized treasuries. So I suspect what that looks like is that you see on-chain yields grow more than you see these off-chain tokenized yields grow. And when it comes to tokenized stocks, I think tokenized stocks are candidly probably not going to see a big growth curve in 2026. I think what you will instead see is that equity perps grow like crazy, because at the end of the day, a lot of the demand, if you look at something like Trade XYZ, which is the perps RWA product on Hyperliquid, that's been growing very impressively. And I think this universe of, hey, I'm outside the US, but I want to get exposure to US assets, stock indices, even commodities. I think doing this in a capital efficient way, in a scalable way, the easiest way to do it is not through tokenization, it's through derivatives. And so I think that is going to take off much more so than tokenization itself. And then,
I think,
go ahead.
oh, sorry.
No, please.
I think in that light, Stani and Sergey, the founders of Aave and Chainlink, were also saying that once the yields are going down on treasuries, it will attract more liquidity into DeFi because the yield in DeFi is just substantially higher.
That's
and
right.
then in your words, the interest into building tokenized treasuries is just going to go down.
It's not that it's going to go down, but I think it's going to grow a lot less than it has grown so far.
Mm-hmm.
So, last year, tokenized treasuries grew over 100%. I would suspect that they probably grow less than or equal to 100% in 2026. And you have to remember, this is on a relatively small base, right? So, a few $1 billion of tokenized treasuries relative to the treasury market is tiny. These businesses, in terms of the amount of bips that they're taking off of treasuries, is minuscule. Managing a few bips of AUM, managing a few $1 billion of AUM of treasuries, you're scraping a few bips off that. So you're not making a lot of money in a business that has a few $1 billion of treasuries on chain. So I actually don't think this is where the lion's share of the economic growth on chain is going to come from.
What about the biggest narrative right now, which is called Zcash?
So we own some Zcash. I think the Zcash team has proven a lot about itself and its resilience and its it being mission driven toward really enabling the cypherpunk vision of privacy. That being said, I think there right now is a little bit, the enthusiasm and the reality are a little bit uncoupled right now. I think people want something to believe in. And if you look on other privacy platforms that are not Zcash, right? So Zcash, you can see the shielded pool has been growing quite a bit. A lot of this has been growth that's been accelerated by near and near intents, which is allowing anybody on any platform to be able to go in and buy Zcash and custody Zcash using the same crypto wallets that they have for any other on-chain activity. So that's been a big entrance way for a lot of people to get access to Zcash who couldn't otherwise do so. But if you look at non-Zcash privacy platforms, right, beyond, okay, the shielded pool in Zcash is growing, people are investing in the asset. Outside of that, you're really not seeing much activity. And so I suspect that 2026, it's a little bit too early for the UX of privacy to be that good. I think what you may see is on some of these stablecoin chains, so on Tempo or Arc or Codex, they have the ability to do privacy-preserving stablecoin transactions. Now, these are not fully private in the way that Zcash is fully private. In these kind of transactions, the operator of the L2 can see your flows, but nobody else can see them, right? So there's some cryptography that's asymmetric, meaning that it's not everybody but you is not that your transactions are obfuscated to everyone but you, but only to a certain sort of compliance function that can see it. Zcash is a different model. Zcash is pure old school cypherpunk. Only you can see your tokens. It's like encrypted Bitcoin. I think outside of Zcash, you're probably going to see very little growth in privacy net, except for these private transactions on stablecoin chains, which are kind of pseudo-private.
Yeah, I agree. I think I visited SmartCon last year, which is where Chainlink is building CRE, which is kind of a settlement layer between those private institutional chains and then the public chains, where it's also a little bit more shielded, where the public chain can see the transactions and the flows, but the rest can't. Yeah. I think that's going to have a lot of growth coming into next year. But as I know that you like to do predictions every year, you're writing down a long thesis onto predictions.
That's right.
We're going to do it into the next level, which is, I've got some cards over here.
Okay.
And I don't know if you can see it. No, I don't believe you can see it.
Yeah.
This year, we've got some years on here, which is, in this case, it is 2030.
Okay.
My question on that is, and there are more, what are you expecting to see? It's not going to be 2100 or whatever bullshit we're going to ask in that sense. But for 2030, which is 4 years from now, if I look back from 2021 until now, 2022, prices have done nothing except for Bitcoin and a few other things. But what do you expect of crypto to be at in 2030?
So first thing I'll say is that anything I say here is going to be with low confidence, because I was around 4 years ago hearing what people thought was going to happen in 2025. And I was also around in 2017. People thought what was going to happen in 2021. And every single time, doesn't matter how smart, successful, connected, prescient you are, everybody got it wrong. Trying to forecast out more than a year in advance, or maybe 2 years, I think is kind of a fool's errand in an industry like this. That being said, so although I object to the having any confidence in such a prediction, I'll go ahead and try to make one.
I would like to challenge you. That's why.
Yeah. Okay. So I'll say, by 2030, I think we're going to have over 2 trillion of stablecoins. I think you're going to see stablecoins be over 15% of M2. I think that stablecoins will still be majority US dollar. Sorry, not majority, overwhelming majority, like 98% plus will be US dollar denominated. I think Bitcoin will likely be, by 2030, maybe, let's say between 400 and 500K. I think the alts market, I suspect that the top 5 is going to look different. I think Binance's market share will wane by quite a lot. I think they will sort of be entering the twilight years where they're no longer as efficient, no longer as fast moving. They sort of start getting dismantled in different countries one by one. And so it ends up, not that they go away, but that they're just not the juggernaut that they are today. And I predict that if you look at the alts market, boy, it's hard to say. I think the alts market is going to be a lot bigger than it is today. I think only some assets will be worth more then than they are now. I'd say like less than half of altcoins will be worth more in 2030 than they are today. But the alt market on the whole is going to be a lot bigger.
I do a lot of trades every single day, and I share that on social media and across our also topic right now. But I find it hard to see if it's a hype or if it's actually fundamental growth, which is the growth in more of equity in terms of IPOs and all those companies that are building infra and crypto. And then on the opposite, you have the token infrastructure that is kind of switching in the pendulum. How do you see that in the coming 5 years? Is that more liquidity flowing into equity, or is it still going to be the token growth?
So if you look in absolute terms, the tokens are still much bigger than the equity. The biggest company that's public today is Coinbase. That's worth about 70 billion or so. Like that's worth less than Solana, and Solana is like top 5, right? So the reality is the token complex is much, much bigger than the equity complex. The reason why there's so much energy and momentum around equity right now is because basically the equity market has recently been unleashed because it was pent up for the last, 6-7 years. Because of Gary Gensler, and of course before that, even Jake Layton, it was impossible for a crypto company to be able to go public, to have clear accounting rules, to have clear ability to work with auditors and all this sort of stuff that now has been cleared away. Even just banking was an ordeal. 10 minutes ago, that was solved. So because of that, we've seen this deluge of companies that ought to be public, that are at the scale and at the maturity that they should be public companies, finally go public. Okay. So now this is being perceived by many people as saying, well, this means that the equity markets are better than the token markets. I think this is a little bit short-sighted. We basically have, again, 10 minutes of history on the equity markets in crypto outside of Coinbase. And we're comparing that to the 10 minutes of history of altcoins being 2025, which was a rough year for alts. So alts have good years, they have bad years. This was one of the bad years. 2024 was actually a very good year for alts. If you remember, we started the year 2024 with everything going into the Bitcoin ETFs. And although ETH had a false start, alts on the whole did amazing over the course of 2024, even before Trump got elected. It was a very strong year for alts, even before the election took place. So all of that is to say, it's unwise, if you've been in the space for a long time, to try to key too much off of 1 year of data. You do not want to do that. Second thing is that a lot of the enthusiasm about the equity markets, I mean, a lot of that was driven, of course, by retail engagement in the equity markets. So, a lot of the DAT buying was happening from retail. If you look at Circle, in the first 6 months, Circle had meteoric rise. Now it's come back down to earth. It's now close to its IPO price at like, 16, 17 billion, which is still, very respectable for a company, given the financials and given the state of the business. You look at Gemini's come back down to earth, Bullish come back down to earth. And so actually I think the equity markets look pretty reasonable. They don't look crazy, but they don't look terrible, right? Now the token markets, you might say, well, they look kind of terrible. But again, these things are very cyclical. So I would not read too much into, okay, well, 2025 tells us that going forward, here's how it's going to be. It's that right now, overwhelmingly, the crypto flows at the margin are coming not from retail, but from institutions. And institutions buy stocks. Institutions buy, IPOs. When that shifts back and you see more retail engagement relative to institutions, that's likely to result in tokens doing well and things like DATs and some of these other retail-driven assets. So that's my high-level view.
I haven't heard you about AI and 2030. If you go into YouTube and you listen to a random podcast, then by 2030 we either are dead or we have a wonderful life because AGI is here.
Yeah.
How do you see the expansion of AI and the impact of AI going into tokens and crypto going 5 years ahead from now?
So hard to say again. Obviously, AI has been very unpredictable so far in terms of how capabilities evolve year over year. I was somebody who was much more worried about AI risk in 2020 than I am today. I think what we've seen from these models is that actually they are getting to human level intelligence and superhuman speeds, but they don't really seem to be surpassing humans in any meaningful way. And it kind of seems difficult to imagine them doing so, given the failure modes that we already see from them, and the paradigm that we have right now is working. It's making progress, but it's making progress in a very uneven way, where things like coding, it's getting very, very powerful. Things like mathematics, it's getting amazing. And then for writing business emails, it's already as good as it's going to get. And then when it comes to solving more open-ended tasks, like being an economic agent, running a business, it seems totally worthless. It seems like there's just not something that it's capable of doing, and it's hard to even imagine how we generate the data to be able to train at scale, to be able to make it participate in the economy and be a useful, rational economic actor. Not to say that we won't, but it's a lot farther away compared to something like coding or mathematics, which we know already how to generate the data to train these models at scale. So my view is that by 2030, we are going to have basically completely automated software engineering. Software will become very, very cheap, too cheap to meter. It will become so easy to create that we'll think of software engineers like the way that we think today about, sewing. Like, it's just not an important job. It's something that you do for fun. But like, if you want to mass produce some shirts, there are no humans involved. It's just all mechanical. The whole thing is just it's a factory. So I think the place where we're going for crypto is that, of course, crypto is entirely mediated by software. There's no hardware or bits, there's no atoms anywhere in crypto that matters. It's all bits. And because it's all bits, that means that the cost of creating crypto startups and creating crypto products is going to plummet. Because the main cost that everybody pays in order to build these startups, in order to build these products, is software costs. Is the cost of building the code and shipping the products. So I think what you're going to see is that there's going to be an explosion of activity on chain. There's going to be an enormous amount of creativity and innovation. I think it's also going to improve security by quite a lot, because the security of a blockchain is ultimately predicated on being able to put the work into securing the contracts and making them safe. And the bottleneck to that is just having good security people. But if security people are extremely cheap, they're too cheap to meter, because it's just, you point LLMs at the problem and you get them to resolve it. I think what we're going to see is a change of perception about going on chain and using the blockchain, that instead of being dangerous, instead of being kind of weird, instead of being, there's only a few products and they're not very good. I think what you're going to see is amazing products being shipped all the time, because anybody can create them for almost nothing and launch them on chain and see what they do. And they're going to be highly secure and very trustworthy.
So then the world in itself is going to be way more efficient than it is right now. And the assumption is that GDP goes up, blah, 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 blah. However, if I hear you say that everybody is able to build a product on chain, it kind of reminds me to the fact that it was almost as easy as possible to create a coin on Solana back in 2024, which then has a lot of positives, but also a lot of negatives. So how do you see the growth of the chains in itself, and the growth of the option of building anything on chain, and then in reverse to that, or the regulation? As in, I can imagine a world where the government is saying, I don't want everyone to build something on chain by that time. Yeah. Because of whatever happens.
So two responses I give to that. First is that when it comes to the commoditization of intelligence, which is effectively what we're seeing with AI. When intelligence is commodified, that doesn't just mean intelligence as an input into building things. It also means intelligence as the way in which the things that get built get used. So when somebody says, you know what, I'm going to build a new, launch pad, I'm going to build a new this, I'm going to build a new that, they have some idea. The people who will be interacting, the customers who will be using those products, they will also have an enormous degree of intelligence gating them from using products that are poorly designed, poorly made, that are insecure, or that simply are just economically stupid. If it's a bad idea for you to use this lending protocol because of the parameters and the this and the that and the whatever, the underwriting, right now, if you look at these private credit platforms like Goldfinch or Maple, you as an investor who's putting your money there, maybe you, because you run a firm, you have the resources and the analysts and the time to be able to underwrite. How are they doing their underwriting? What's their underlying loan book look like? What does the resilience of this company look like? Because you have the resources, you can do this. But a retail investor can't do this. Right? They just don't have the time, they don't have the resources, they don't have the sophistication, they don't know how to do due diligence on something like this. But their AI will. Their AI will be better than your best analyst is today. And that AI is going to be so democratized that basically it's going to be an enormous forcing function on every startup that you'd better be really good or you will get zero customers. And of course, your AI knows that other AIs will be looking at it this way, and it will design the products in such a way that they're actually very good, right? The thing that you see today when you look at, Claude Code and some of these agentic coding systems is that it's not that, they're really good at identifying when they write bad code. It's that they don't write bad code. They just don't do it anymore. They used to write terrible code all the time. Now they just don't write bad code. It just doesn't happen. So that is going to be, again, a forcing function on it will bring the floor up on everything. It simply means again, today compared to 50 years ago, it's not that there's still a market for, I don't know, like Cracker Jacks, right? Just like some old timey snack that people used to eat in the 50s that kind of sucked. It's not that there's that and there's also Cheetos. It's like, no, there's only Cheetos now. There's Cheetos and Lay's and everything's great. The answer is you go to a supermarket, anything you eat is delicious. That is what it's going to look like on chain, is that everyone's taste will change because they will have this intelligence that's democratized in front of everybody that will allow them to make better decisions, safer decisions, smarter decisions. Now, what are governments going to do in response to that? Now, the first thing to understand is that, why do governments even care about crypto? Why does the US government care about crypto? The answer is of course, the age-old reason, investor protection. Investor protection. And the theory of investor protection is that retail investors are stupid. They're not sophisticated. They will get swindled and defrauded because of people who are more sophisticated than they are taking advantage of them and tricking them and defrauding them, right? That is the premise of the investor protection regime. And that is the theory why we've been regulating crypto. All the assault that we've been getting from the SEC is under this premise that this stuff is fraudulent. It needs to do disclosures. It needs to, come under the securities regime, not because it can't exist, not because oh my God, crypto is per se dangerous. It's that it needs to come under the disclosures regime of the securities laws to protect investors. Okay. What I'm describing is intrinsically empowering retail investors to have the same protections and the same intelligence that's protecting them from making bad, unsophisticated investments that currently exist for institutional investors that the SEC has decided don't need protections because they're sophisticated enough. So I think the whole paradigm around this is going to change. Now, if you are regulating crypto for a different reason, let's say you're China. China is not regulating crypto for investor protection reasons. They banned crypto for capital flight, right? It's capital controls. That's why they are regulating crypto. Now, if that's the reason why you're regulating crypto, then that's a different story. And none of this is necessarily going to apply to the sort of realpolitik of protecting financial flows. But I think at the end of the day, giving people access to AI is going to result in a shift of power. It means that individuals are more powerful. They're more intelligent because the government already had a lot of intelligent people. The government has great analysts. They have people who can write laws and they can, engineer tax codes and give away favors to powerful people in ways that are inscrutable to the average person. But when the average person becomes more and more intelligent, when they have an agent that can process everything that's happening and explain to them, okay, which candidate is actually doing things in my interest? Which of these law, what does this law actually mean for me? This politician is telling me that this tax code is going to result in, lower taxes for me. Is that really true? The AI will now no longer need the government to tell you what's going to happen. It will tell you what's going to happen. It will read it for itself and explain to you veridically what's actually going on. I think all of that is going to result in a massive change. Every technology that's big enough results in a massive change of power between governments and individuals. Or, in previous times, you think of the printing press, a big bounce of power from the church to the individual. Same thing happened with television. Used to be all information dissemination at scale happened through mass media, happened through the television. And of course, every country in the world, including the US, controlled the airwaves. Right. So obviously in authoritarian countries, explicitly all the TV stations were nationally controlled. Even the US, the FCC decided what you could say, what you couldn't say, what messages were appropriate during what hours. After the rise of the internet and streaming, all of that went away. The government doesn't control the airwaves anymore. And de facto, it did just 20 years ago. I think both crypto and AI will have the same impact, where crypto removes the ability of governments to control financial freedom and decision-making of their populations. It doesn't remove it completely. There's still choke points. There's still banks. There's still, fiat payments and so on. But it is another lever by which individuals can reassert that control in every country in the world, not just in the US, not just in Western Europe. And the same thing will be true of AI. So that's my view.
I think we can have an hour conversation or more just on AI, but I have to proceed with the cards.
Yes, of course.
And I've got a new year for you, which is a little bit easier. It's 2027. And the question that I have here is this going to be the year where we start valuing protocols like Santi is doing?
No, it's not. Look, building what we're trying to build here with blockchains is a multi-decade process. Multi-decade process. This is not something that happens within a few years. Solana was created in 2020. Okay. It's not that old. If you think about the big trends that have really changed societies, we were just talking about the printing press, so let's say we ignore that. You think about things like, the rise of the internet, the rise of telecoms, the rise of television, the Industrial Revolution. All of these processes took decades. Even the internet took decades. The internet took 20 years end to end, or even longer, depending on where you start the clock on when the internet began, of when it actually fully transformed society, and we knew, this is what the internet is. This is the way it's going to impact society. This is the way it's going to grow into and subsume our lives. With crypto, it is still too early for us to really fully know that and perceive it. The reality is right now, the assets of the world that are stored on blockchains rounds to zero. It is almost nothing compared to the world's wealth that is actually denominated on chain. Bitcoin is worth a lot. It's worth 2 trillion. That's big. But everything else is tiny. So what that tells you is that, look, we still don't know. It's possible that the only thing that matters in crypto is Bitcoin, and all this alt stuff just remains a sideshow. And if that's true, it's too early to say. It's too early to know whether that's true. So you have to be patient. The market is patient. The market understands this, is that it's going to take a long time to discover what this technology really is and whether or not it's going to win. And so I think by 2027, we're still not going to know. We're going to have more data points, always gathering more data points, always updating our priors, but it's probably going to take at least 5 to 10 years before we really have a good idea of, is this stuff going to eat everything, or was it a mirage?
I think if you look at the impact of like institutions in general, there's been so much hype about, hey, we've got the Genius Act, institutions are stepping in. Larry Fink is saying tokenization. They have the Biddle Fund investing like millions and millions into the entire ecosystem, but then the entire year passes, nothing really happens. But what we do get is a gazillion amount of layer 1s and layer 2s. And at some point in time, you need to see some progress. So I would assume that next year, not this year, we at least start to see more demand coming into all those layer ones, into those layer twos. There are more narrow layer twos coming in, like for instance, Arbitrum and Robinhood, or all those other things like Near with Near Intents. They have a sole use case.
Yeah.
How do you see the entire growth of the layer one and layer two ecosystem 1 year ahead? Is it going to keep on expanding, or are we going to erase a lot of layer ones like we did in the past?
I think it's a combination of both. There's always some extinction and creation that's going on in any healthy ecosystem. I mean, this is just capitalism. You know, it's like, it's never, there's only one restaurant in town and all the other restaurants just give up. There's always competition. And when the prize is big enough, there's never just one of anything. There's never just one. There's always going to be challengers coming for the throne. And the throne, especially when the throne is really big and really valuable, you know, when Ethereum is worth hundreds of billions of dollars, when Solana is worth almost 100 billion, there's a lot of people who want to see if they can try their hand at becoming the next. So I don't think there's ever going to be a moment where we say, aha, we're done now. We kind of know who the winners are. And, you know, remember, it was just a year and a half ago that Solana rose from the ashes to become, from being basically a ghost town and a nothing chain to being top 5, right? The fact that that just happened 2 years ago tells you history is not over. It is not the case that, well, clearly it can't happen again. It only happened 2 years ago. Never again will that ever happen. No, of course not. And that's not the way that markets think. It's not the way that entrepreneurs think. So the idea like, well, we have too much block space, don't you know? It's like saying, oh, don't you know there's too many restaurants in New York? There's already great restaurants. Why would we need another restaurant? Fuck off. No market works that way. No entrepreneurs work that way. So there will be more. Now, are there going to be great ideas? Are there going to be great challengers? Are there going to be, is there a new names on the block that are going to be able to challenge Ethereum or Solana? I don't know. I don't see a ton of great, really teams that have yet to launch. There's a few, there's Mega ETH, obviously Monad just came out very recently. But it is a challenging field to make progress in, but there will be challengers. There absolutely will be more challengers. Now, will there be extinction of older layer ones? Of course there will be. We're already seeing it. There's people kind of going out and being taken out back and shot every single day. I mean, you just saw Flow went down 50% after getting hacked. Flow is more or less a dead chain. There's not a lot going on there. And
Parachain.
There's many that have kind of launched, flopped. There's not a lot going on there, and probably they'll sort of die a slow death. Again, this is normal. This is capitalism. This is creative destruction. This is what happens in every market ever. So the people, I think, who are, they're dismayed by the idea that people are launching new L1s when we already have a lot of L1s, I think are stupid. They're short-sighted. They're complaining about the oldest thing in history, which is capitalism, which is economics, which is the ambition of entrepreneurs to want to win the most important games and win the biggest prizes. So I don't begrudge anything against a founder who's coming in and saying, I'm going to build the next Ethereum. I say, great, go for it. If you have a great idea, go do it. You're only doing so at your own cost.
Let's continue with the cards. I've got two more.
Okay,
the first one.
Okay.
Last one is going to be easier though.
All right, 2035.
2035. Is crypto going to be classified as a success or a complete failure by then?
I think.
What are the odds on this?
Success. I think it'll be clearly a success. I mean, I don't think we're going to be talking about it like a success or a failure. I think crypto will be so boring at that point and so old hat. Understand that.
I wish it is.
Look, I got into this industry when I was, what was I? 27 when I came into this industry full time. It's been 10 years, right? I'm going to be fucking in my 40s talking about I was in my 20s when I first got into crypto. It was so exciting back then. Crypto is going to be boring. Everybody who talks about it a lot is going to be in their 40s. Young people will be talking about something totally different. It's not going to feel the same in 2035. It's going to feel like one of these things just existed forever. It's not cool. It's not edgy. It's not like, oh my God, can you believe it that this guy bought crypto? The people who think that crypto is a scam will be mostly dead, or they'll be nursing homes. So it's just going to age out. It's not going to be. We're not going to look at it in the same way, right? People today, we just take the internet for granted. We don't talk about like, wow, can you believe it that we're all connected in cyberspace? Can you believe that everybody in the world can talk to each other in real time? Nobody talks about that anymore. Nobody talks like that anymore. It'd be absurd to talk like that. And in the same way, it's going to feel absurd to talk about crypto the way you and I are talking about it in 2035.
Are you going to be spending more time in crypto or in poker by then?
I don't spend any time in poker, so probably crypto relative to poker. By 2035, I have no idea what I will be doing. I suspect that by 2035, I will not be a crypto VC anymore. I suspect that crypto.
How so?
Well, I suspect that crypto VC probably doesn't have, like, it probably just blends into technology investing, right? Like, there's no internet VCs anymore. It's just investing, tech investing, right? In the same way, crypto is just going to be so ubiquitous and normal that it's just kind of weird to be a crypto VC. It's like, yeah, you won, you got it. Okay, we're using blockchains, and yeah, crypto's a thing. It's like, there's no social media VCs. There's just VCs. There's, consumer VCs, right? And so I think on that level, maybe we're a fintech VC because this is just perceived as, well, this is just financial technology. Like, what else? If you talk about financial technology, what, you're going to build on COBOL and like these super old banks? Like, no, everyone's moving in the obvious direction. And so I think being a crypto VC and the idea that crypto is this risque cypherpunk kind of thing, I think that's going to be gone by 2035.
Are we going to be entirely on chain by then?
No, I don't think we're going to be entirely on chain. No, I don't think so. In the same way, it's like saying, are we entirely online? It's like, well, no, there's still a lot of stuff that's not online. And there's obviously a lot of businesses and systems and things, like I just went to the dentist recently and I filled out a form on a piece of paper, and somebody took that form on a piece of paper and was typing it in. And it was like, why didn't you just let me type it in? I could have just typed it in. Why did we do this paper thing? This, not everything's online either. So I don't think everything's going to be on chain, but is the blockchain itself going to be a backbone of financial activity everywhere in the world, or most places in the world? Yes.
Fair enough. Let's go on the final card, which is obviously going to be next year.
Yeah.
It's the start of a new year. As a matter of fact, the markets have been into an ETH market since I think the summer already. ETH has been structurally outperforming Bitcoin.
Yeah.
At least in terms of price, but also in terms of stablecoin supply going up by 70% last year on ETH. How do you see crypto, Ethereum, DeFi evolve over the coming year? You mentioned it's going to be a great year for alts. I'm sure a lot of people will love to hear that, but what are your expectations going forward?
I do think that ETH, Solana, the big old ones, I think they're going to do well this year. I think that, I made the claim earlier that the fintech chains will underperform. I think a lot of people will have a little bit of magical thinking about what is going to happen as a result of Tempo or Robinhood Chain or ARK. I think the incremental stablecoin demand is going to be mostly driven by the main incumbent chains, and I think they're probably going to be beneficiaries of that growth. I think the other side of that too is that the altcoin complex, I don't think it's going to be a crazy, wild, blow off top kind of year. I think that alts they'll just gently do well. I suspect that there's been such a leverage reset and flushing out as a result of 1010, the big leverage cascade that we saw in October, that it just creates a very strong basis for a recovery, right? A lot of people, I was saying this just a couple months ago. Now, markets are starting to feel a little bit of relief, but if you remember a couple months ago, there was so much negative sentiment going around on the internet about crypto. There were all these people talking about quitting the industry, people talking about, hey, we haven't built anything of value, I'm done. This whole thing is just this worthless casino. And one of the things I said at that time is that this is good. This is good. Why is this good? This is good because if you have lost the ability to fight in this war, then you need to be sent back home. Because the only way that we are going to be able to win the war that the crypto industry is fighting against the legacy incumbents that it's been here to take on from the very beginning, the only way it's going to win that war is with a spirited and determined set of warriors willing to fight. And if you are done, if you are checked out, if you are disillusioned, it's tough to say, but it's time for you to check out. It's time for you to go. And only when those people who are disillusioned have all left can the industry actually start to recover. So those people who say, oh, you know, I don't believe in this stuff anymore. I finally capitulated. I finally sold all my tokens. Great. The only way the industry can move on is when you are finally done selling. And so I think that actually was a very necessary reset for the industry, is the people who didn't really have conviction, when they saw the fundamentals looked amazing. The regulatory position of crypto, stablecoin growth, you know, Bitcoin's acceptance and ascendancy as an asset, like the institutionalization of all of the concepts that we've been preaching for years, all the fundamentals of crypto have looked amazing. And the prices were stagnant. And if that was enough to get you to say, I'm done, we didn't build anything valuable because tokens didn't go up, then get out of here. Like, you're done. You're checked out. We've gotten as much use as we're going to get out of you. But everybody else who's left needs to focus and build for crypto to be successful.
If someone is listening, then I've seen this question come along on my social media quite a lot. But last year it was, who's selling? Who in the world is selling those assets at those valuations? Like, why would you do that?
Yeah.
Same question will start to pop up right now with the markets going up. Like, who the fuck is buying those tokens that are not useful?
Yeah.
So my question then to you is the exact same. Who is going to be a buyer into the markets? Is it going to be hedge funds? Is it going to be VCs that have a liquid arm? Is it going to be retail? Who's going to carry this market forward?
I mean, it's an age-old question. The first two I can tell you is no. It's not going to be hedge funds, because right now hedge funds, they have zero interest in crypto. It's especially not into altcoins. So it's not hedge funds. And you can see actually a lot of hedge funds have exited their crypto arms over the course of 2025. It's also not crypto VCs. Fundraising among crypto VCs has been terrible over the last year. Mm-hmm. And more of their LPs are demanding actually that they spend more time on privates and less on publics. So, you know, the era of, you know, the big mega funds raising billions and billions of dollars and then deploying that into just, you know, the slush fund of alts, that is going away. It's not VCs that are going to be the marginal bid for a lot of this stuff. So the question then poses itself of like, okay, well, who's buying this shit? Even when you look at the VCs, right? I mean, the VCs in aggregate, maybe there's like $10 billion of total demand. That doesn't get you to the numbers that we saw. You know, that doesn't get you to multi-trillion-dollar asset class. So who was buying? And of course, the other thing about VCs is that they buy and then they sell. They're not necessarily going to be long-term holders of a lot of these assets. So where is the demand actually going to come from? The answer has always been the same. It's individuals. It's retail investors. It's always been true in crypto. Anything outside of Bitcoin, there's no institutional bid. It's not hedge funds who are going to save you. It's not VCs who are going to save you. It is other people like you who believe in this stuff and are willing to buy it and hold it for a long period of time. Now, when I say individuals or retail, that doesn't mean unsophisticated people. More and more over time, the marginal dollar concentrates into more sophisticated hands relative to unsophisticated hands, right? The unsophisticated people are buying meme coins. They're buying, you know, Dogecoin. They're buying IOTA. They're buying whatever, all sorts of random crap that's just getting nuked from orbit, right? They're buying Hashgraph, blah, 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 all this stuff. It is the smarter money that ends up concentrating to the assets that do well over multiple cycles. And so I think this is what you're going to see in the long run, is that there's just lots and lots of individuals who have capital, who play in the altcoin market, and they are just going to say, hey, this stuff is oversold. Momentum breeds momentum. I mean, we've seen it 1,000 times. You've been in this crypto industry long enough, so have I. I've been in this space too long to be able to tell myself such a simplistic story that, oh, if there's no hedge funds and VCs, then nobody's going to buy this stuff. It's just not how it works.
Is it also because of like literally every asset is so overvalued at this point? Like if you go to the Max 7, it's like if you look at commodities, they have just had a massive run, which creates a lot of irritation for anyone involved in the altcoin markets.
Yeah.
But is that also from a higher level that people are feeling the needs of inflation and then the urge to go more risk on to continue having the same lifestyle in order to like, I need to make more money, so I'm willing to put more money into an asset class that's riskier? Is that same mantra going to happen this year again?
I think a lot of it really depends on the price level. At the end of the day, a lot of the attraction of crypto is momentum. Crypto was actually pretty low volatility over the course of 2025 relative to previous years. And then it had spikes of going down, but it was mostly going down, up and down with everything else. So it's not as though it had idiosyncratic volatility. The only idiosyncratic volatility we saw was really on 1010. Most of the other volatility, it's like, okay, tariffs, trade wars, all this stuff, that was happening to everyone. That was happening to everything. The NASDAQ had a huge drawdown at the same time that crypto did. So the idea that like, well, if you really want volatility, go to the crypto markets was not true. It stopped being true. And if that's not true, then it's not where the marginal retail investor is going to be finding these storylines to chase. So I think the reality is that crypto is going to get a muted bid so long as the equity markets feel wild and crazy and volatile. And they do, because of this crazy AI energy that we're seeing in public markets. That's going to continue for a while. Honestly, I don't think it's going to abate, which is why I don't think there's going to be some crazy blow off top in alts. I think alts are going to stage a recovery, but just because of the price level and sentiment level is so low that just mean reversion. I think it's a lot of ways to see it. It's mean reversion and just the broader pro liquidity risk on environment. But I don't think that we are at the end of the road for the AI boom. Possible that we see some jitters in the market. We already saw a lot of jitters in the AI market late last year. And to the extent that we see more of that this year, maybe that stages a bid for crypto. But I think the thing that crypto is fighting for is not that it looks more attractive on a relative basis of valuation. I think the thing that crypto is looking for is that it's actually more momentum driven than AI. And I don't think it's going to get that this year.
If we talk about VCs, I'm quite sure you've received some well-written context and feedback from people that are saying, because of you, the markets are going down, as in general.
Because of
VCs
me, or because of VCs generally. Okay, yeah, VCs generally.
Yeah. They have received a lot of negative feedback.
Yeah.
What do people not understand about VCs and your role in the entire ecosystem? Because it feels for a lot of people that you're just in here to make money and then say bye.
Yeah. Well, I mean, there's so many things that are wrong with the story. So first, everybody is in this to make money. VCs are obviously in it to make money. Market makers are in it to make money. Binance is in it to make money. The founders are in it to make money. And so are retail investors. Everyone's in it to make money. So the fact that, in 2025, you saw altcoins go down, altcoins do poorly. 2024, altcoins went up. 2023, altcoins went up. 2022, they went down. 2021, they went up. The constant through all of these years is that there were VCs, there were market makers, there was Binance, there was retail, there were founders. Every single one of these cannot none of these can explain why tokens went down in a certain year or went up in another year, because they're all, there's not a controlled experiment. There's no A/B test. All of these people were all present and all trying to make money in every single year. So the idea that, I can explain why this year prices went down, it's because of VCs, or it's because of Binance, or it's because of this thing or that thing. Obviously, this is a terrible explanation if the thing that you're ascribing the market to was present in every other year. So that's one reason why this is a obviously stupid story. The second thing is that the scale of the losses in altcoins, right? Most of the most of the people who get mad about altcoins say, it's because of VCs and founders dumping or whatever. Almost all these are recent launches. In almost all of these cases, founders and investors are locked until 1 year after the launch. So if you're talking about the vintage of 2025 tokens doing poorly, nobody was able to sell those yet. The only people who could sell those are retail investors, airdrop farmers, And maybe market makers, if you have some conspiratorial views about market makers, you could potentially levy that against them. But clearly, it cannot be VCs or founders. They're locked up. Go check the chain. You can see the addresses. You can see the lockups. They're enforced on chain. So this is clearly not a good explanation of what's going on. And the last thing is that this is just simply a story that explains too much. If your claim is that VCs systematically make it impossible for an asset to go up, how do you explain IPOs? Okay, IPOs are an event where there's a company that goes public, and to be clear, and most people say, oh, well, the IPOs are more mature. Most IPOs are not profitable. Most IPOs, they're not profitable companies. Almost all IPOs are money-losing companies. In tech companies, not I don't know, if you're an oil company or something, maybe you're profitable. But when a company goes IPO, relative to crypto, in crypto we have 20% of the total supply is sold to VCs. That is not what cap tables look like for IPOs. Okay, when a company IPOs, usually 60-70% of the cap table is investors by the time a company IPOs. They've sold so much equity to finance this company, not in every case, but in probably the median case for a venture-backed tech startup. They've sold so much of the cap table to equity investors that by the time a company IPOs, right, and then, there's a lockup, and eventually that lockup expires after 6 months or whatever it is, all those investors can sell. And they generally do. And so nobody looks at the IPO market and says, wow, this is a systematically broken market. Obviously, these VCs are extracting, how could this market possibly work with all the sell pressure that's going to be just, dropping on people's heads and screwing over retail investors. Nobody has this mental model of IPOs. But in crypto, we have the story that, well, this must be what's happening with VCs. They're, all dumping, and that's why the markets are going down. So if this is true for crypto, why would it not be true for other markets as well? It's not true for other markets. And the story, oh, well, because they're profitable. No, they're not. Most tech startups that IPO are not profitable. So so all of this is to say, long story short, VCs exist. There are good VCs and bad VCs. They've always existed. They're a mainstay of crypto since 2018. Crypto VCs have existed even before that, but that's when they became sort of significant players. They cannot explain what happens in any individual year. What happens in any individual year has much more to do with that year than it has to do with, somebody who I can identify in the supply chain of tokens got greedy and is now extracting. That is almost never the explanation of what's going on in the market.
Fair enough. That's a good explanation. I think, though, that still most listings should be improved a little bit more, or maybe a protocol should be a little bit further into there. Like, not before a testnet goes live, they go public with the token, or maybe they need to actually attract a little bit more users before they go live. All those things are still very important. But
so I agree with that in part. I agree with that in part. I think that the better answer to all of this, though, is just that prices need to go down.
Yes.
Right. If something launches and it goes down 70%, that means that if it was priced 70% lower, it would have been fine. And so markets can solve this problem. They've been solving this problem since time immemorial. This is not a new concept. If something, when it launches, goes down, people price it lower. I am doing that. I'm a VC. When I go see a deal and I'm like, hey, all these tokens have done bad, I price things lower. And when I price things lower, they go out lower. And when Binance sees that, their last round was lower, they price you lower. And that price signal moves through the supply chain with some constancy. Now, in 2021, if what you remember is that when tokens launched, they always went up. Everything went up. And that means I think it was priced too low at that time. And markets figured that out and they started pricing things higher. This is this is not rocket science. This is not, wow, we invented blockchains and therefore we need some complicated solution in order to solve this problem. No, this is a very simple problem and it requires very simple solutions, which is just change the prices. The prices are too high, bring the prices down.
How is that in terms of valuations of all those pre-TGE protocols that, for instance, you and I are investing in? Like, our strategy is going more into liquid positions because of the fact you're not being locked. You can buy on the open market. Usually valuations are lower. Did you adjust your strategy yourself, or?
Yeah, so first I'll say we're pure play VCs. So we don't have the ability to say, we don't like VC this month. We're just going to go buy some liquid tokens. So with that caveat, the answer for us is that we're patient. If we feel like the market is not setting prices that are reasonable or that entrepreneurial expectations about pricing is too high, we'll tell them, look, we love you. We think you're great. We think this price doesn't make sense. But we hope that you end up finding somebody who's willing to bid this price. As a VC, you do not have to write checks. You don't have to. If you feel like things are overvalued, like we are the price signal. We are the way the price signal propagates up the capital stack.
Mm-hmm.
And so I think it's not just incumbent on us in order to generate good returns for our LPs, but it's also incumbent on us in our role in the ecosystem, right? Us playing our role in the ecosystem is us propagating that message to founders to say, hey, this price is too high. It's not something that we're open to paying. But if you're willing to reprice, you're willing to consider a lower valuation, then maybe we'd be open to doing this deal. And we don't do it in a way that's like, hey, you're wrong or you're a bad person for wanting this price. And if somebody's willing to pay the price, look, go for it. Congratulations. All the best to you. But I think that discipline is a big part of the reason why, our returns are what our returns are, but also why, you can end up surviving across multiple cycles. If you're always a taker and you're never saying, hey, I think this thing is mispriced, then you're not going to survive long enough as a VC to make it through multiple cycles.
If you, as a round off, if you want to survive as a retail investor in these markets, what advice would you give to someone going into 2026?
Advice
Go long 10x on whatever meme fund there is.
Probably long 10x. I'd say, look, it's kind of there in the question, right? Which is survive. Like focus on survival.
Mm-hmm.
And it's very easy to say that and not to do it, right? So the one thing that's very clear is that, when I got into space full time in 2017, and anybody who bought anything in 2017 and survives today made a lot of money. But I know so many people who came into the industry in 2017 and did not make a lot of money. And now why? The answer is very simple, because they didn't survive. Doesn't matter what stupid shit they were buying. Doesn't matter how bad their decision-making was. Doesn't matter how non-technical they were. Didn't matter how much of a retail investor or not they were. As long as you stayed in the market, you did great. You could have made so many mistakes. You could have done so many stupid things. You could have been wrong about almost everything. But as long as you stayed in the market, you were fine. So stay in the market. Stay alive. Never allow yourself to be taken out. That I think is the simplest and most useful advice I can give to somebody who's trying to make it in crypto.
That's to everyone, including myself as a founder and the fund and the VC, just like you.
That's right.
Thank you very much for spending the time with us and to go over these topics and to go over the cards and the predictions for the coming years. For people that are interested into hearing more about in-depth thinking about